So imagine you're standing on this really busy city sidewalk, right?
Okay, I'm picturing it.
And up ahead, on the left side of the street, there's just this massive multi-car pileup. Sirens are wailing, there's glass everywhere. And naturally, every single person on the street, and I mean including the entire global financial market, is staring intensely at that crash.
Right, they're completely fixated on the visible wreckage.
Exactly. But while everyone is, looking left, they are completely oblivious to the massive sinkhole silently opening up right beneath their feet.
Which is always where the real danger is.
Right, and that sinkhole is a global food subsidy crisis. So welcome to today's deep dive. We're getting into some heavy stuff today because while the broader market is busy pricing the geopolitical conflict in Iran as like a standard oil shock, the data sitting on our desk today proves they're looking at the wrong disaster entirely.
Yeah, it's a fundamental misdiagnosis.
And we've got the receipts right. We're looking at recent analyses from Bank of America's Global Economics team, BlackRock's Investment Institute, and some fresh IMF data.
And what's really striking across all these sources is that the consensus is just running their standard 1970s or 2000s oil shock playbooks. But the BofA strategy note from April 8 makes this really compelling case that we are not experiencing a traditional oil shock. We're in the middle of a gas and fertilizer shock.
Which is totally different.
Completely different. The damage isn't showing up as a spike at the gas pump, right? It's quietly hollowing out the sovereign balance sheets of emerging markets.
So I want to start by looking at the specific molecules driving this, because to understand the sinkhole, we basically have to transition our thinking from macro geopolitics to the literal chemical components of agriculture.
Literal molecule.
All right. Bank of America calls this the reclassification premium. They're pointing out that the Iran conflict is specifically an energy shock in natural gas, fertilizers, and petrochemicals, not just crude oil.
Yeah, and that distinction is everything.
It is, because if we look at the mechanics, natural gas isn't just used to heat homes or run power plants. It is a raw chemical feedstock. I mean, it accounts for roughly 85% of the cost of producing ammonia.
Wow, 85%.
Yeah, and ammonia is the non-negotiable base ingredient for urea and all those nitrogen-based fertilizers.
Which exposes this massive vulnerability in how global institutions actually assess risk. I mean, look at the IMF's baseline models.
Right. The models for countries like Egypt, Kenya, Bangladesh,
Pakistan, the Philippines, yeah. Those architectural frameworks were primarily constructed to measure a country's sensitivity to crude oil. They were simply not built to model gas-to-grain transmission.
It's such a severe blind spot. It's like a city prepping for a massive hurricane, because their historical models say, a hurricane is coming, but what actually hits them is a multi-year drought.
Yeah, they just have the wrong umbrellas.
Exactly. They have the wrong mitigation strategies. So if natural gas prices spike, how exactly does that immediately hit a country's food supply? Like, break down that gas-to-grain transmission for us.
So a gas price spike isn't just an expensive heating bill, right? It's an immediate production cost crisis for domestically manufactured fertilizers. You go straight from a gas pipe to the farm gate.
Just bypassing everything else.
Exactly. And the transmission speed is what makes it so destructive. When the cost of nitrogen fertilizers skyrockets, agricultural yields drop almost immediately. That is, if farmers can't absorb the cost.
And they usually can't.
No, they can't. Which puts the governments of these emerging markets in a brutal position. They face this binary choice. Option A is to let the true, inflated cost of fertilizer and food pass through to the consumer.
Which, in countries with high poverty rates, almost guarantees immediate social instability.
Riots, protests, political upheaval, right? So they go with option B, which is to absorb the shock at the state level by implementing massive energy and agricultural subsidies.
To artificially suppress the price.
Exactly. But absorbing those costs destroys their fiscal deficits.
And this is where we get into what the BofA note calls the illusion of health. Because, a government's external account projections might look perfectly clean to a foreign bondholder, but the internal fiscal deficit is just rotting from the inside out.
Yeah, and they're hiding that rot using a shadow ledger.
Right, the shadow ledger. Let's dig into that, because the IMF's December 2025 review of Ghana is just the perfect case study here.
It really is, because governments understand that showing a ballooning deficit on their official balance sheet will cause their bond yields to instantly spike.
So they use off-balance sheet instruments.
Exactly. To secure the dollar liquidity they need to buy imported fertilizer, they turn to heavy use of FX swaps, encumbered assets, and really complex derivative-based borrowing.
Okay, wait, I want to stop on the mechanics of that shadow ledger for a second, because if I'm an investor, I'm looking at the official spread and thinking, okay, everything is fine. But underneath the floorboards, there are millions of euros in hidden derivatives.
Oh, absolutely, and it's incredibly common.
So, to clarify for you listening how that hides the debt. A central bank can use an FX swap to exchange its local currency for US dollars with a foreign institution, right? And they agree to reverse the trade at a future date.
Right.
It gives them the immediate cash they need to import that expensive natural gas. But because it's technically structured as a currency transaction rather than a traditional bond issuance, it totally sidesteps the headline debt thresholds that the IMF monitors.
That's spot on. And encumbered assets function in a very similar way. A government might pledge future state revenues, like future port tariffs or the receipts from a state-owned commodity exporter as collateral for immediate cash.
They're pawning their future income.
Exactly. They're pawning the country's future.
Yeah.
And this borrowing bypasses the standard sovereign bond market entirely, keeping the headline metrics artificially clean.
And the scale of this is just staggering. I mean, the sources mentioned that late March disclosures showed Senegal was holding 650 million euros in undisclosed derivatives positions.
Yeah, 650 million. And it's not an isolated accounting error. This shadow fiscal deterioration is basically endemic to the Francophone African sovereign universe.
Because, as the note points out, a fertilizer subsidy isn't a one-time import cost. You don't just buy it once to weather a storm.
Right, it's a recurring budget line. You have to fund it every single planting season.
Quote, structural and molecular, not cyclical and negotiable.
Yeah, that quote sums it up perfectly. So if the floorboards are rotting, the analytical next step is identifying who is standing on the weakest wood, who falls through first.
Right, the importer ladder. The analysts break this vulnerability down into 3 distinct rungs.
Yeah, let's look at rung 1. These are the countries with what the market calls shallow buffers. Broadly, these are emerging market importers with huge external financing needs, places like Egypt, Bangladesh, and Pakistan.
Pakistan is such a fascinating anomaly here because they have this IMF program that theoretically creates a financial floor. Plus, they get what the note calls geopolitical rent.
Right, for acting as a U.S.-Iran intermediary.
Exactly. They get financially compensated for their geography. But the analysts argue that this safety net is creating fiscal illusions because that IMF program was calibrated for just a slight fiscal adjustment. It was absolutely not built to absorb the dual shock of unbudgeted military spending and these massive new fertilizer subsidies.
Yeah, the geopolitical rent is basically just masking the internal bleed. But while the market has, some awareness of rung 1 risks, rung 2 is where the consensus is completely blind.
The gas amplifier.
You're right, because the market tends to categorize countries in binary terms. You're either an energy importer or an energy exporter. But rung 2 is countries with robust domestic fertilizer industries that still rely heavily on imported energy inputs.
Like Morocco.
Morocco is the textbook example. Their OCP group is the world's largest phosphate exporter.
So on paper, if you're a global investor, you think, oh, Morocco must be profiting massively from a global fertilizer shortage.
Right. But the mechanism of making phosphate exportable requires immense amounts of imported natural gas and sulfur.
So it's an energy echo. It's the equivalent of, like, getting laid off from your job on the exact same day your landlord doubles your rent. Your income drops right when your survival expenses explode.
I love that analogy, yes. A global gas shock crushes Morocco's export margins right at the exact moment the government desperately needs OCP's dividends to pay for food subsidies.
And the market completely misprices this because they aren't looking at the molecular supply chain. They just see phosphate exporter and assume they're fine.
Which brings us to the third rung, and honestly the most insidious one, rung 3, the stagflation trap.
Ah, the Philippines.
Yeah, the Philippines is the prime model here. In these economies, the gas fertilizer transmission basically arrives as imported inflation. The rising cost of energy and food forces the central bank into a brutal corner.
They have to choose between raising interest rates to fight inflation, which crushes that own growth, or keeping rates low to support growth and just letting food prices spiral.
Exactly. And the April 5th dispatch actually highlights a quote from the Philippine central bank governor who admitted they were caught between a rock and a hard place.
And what's so critical is how the market misinterprets that communication. The market hears that and prices it as a standard monetary policy observation. But the strategy note insists we have to read it as a sovereign credit signal.
Right. The IMF's original modeling had high global commodity prices listed as just a downside risk scenario.
Hmm.
But now that downside tail risk is their everyday operating reality.
So if all these countries are facing massive structural risks, hidden derivative debt in Senegal, margin collapse in Morocco, stagflation traps in the Philippines, why isn't the global market panicking? Why aren't we seeing emerging market sovereign bonds in free fall?
Well, the lack of panic really comes down to this phenomenon BlackRock identified as the exporter dividend, combined with a massive statistical masking effect.
Right, because Latin American net energy exporters like Ecuador, Colombia, Mexico are actually highly resilient right now. Because the Strait of Hormuz is facing geopolitical constraints, the energy produced in LATAM is trading at a premium.
They're having a structural boom. But the issue is how global finance groups these countries together.
The compositional illusion.
Yes. These thriving Latin American energy exporters are bundled into the exact same massive index funds, like the MSCI Emerging Market Aggregate, as the struggling Asian and Sub-Saharan African importers.
So if you're looking at an average emerging market fund, it looks perfectly healthy. But it's a statistical trick. It's like having your head in the oven and your feet in the freezer.
And the statistician tells you that, on average, your temperature is perfectly comfortable at 70 degrees.
Exactly. Meanwhile, half the countries in the fund are literally burning through their central bank reserves. The booming export numbers from Colombia are mathematically canceling out the sovereign spread widening that should be flashing red across Africa and Asia.
But there is one specific metric that sees through this compositional illusion. And this is where Bank of America's volatility desk is flashing a severe warning.
The VIX warning.
Right. The VIX, the volatility index, is sitting in the mid-20s right now, which is elevated well above realized volatility, which is in the mid-teens. And more importantly, the VIX curve is unusually flat.
Okay, I want to break down that specific metric for a second, because a flat VIX curve is highly technical. Normally, a volatility curve is in contango, right? Meaning it slopes upward.
Yeah, indicating short-term risk is lower than long-term uncertainty.
But a flat curve at elevated levels means the market expects immediate, sustained risk with no relief in sight. So why does BofA interpret this not just as equity market nervousness, but as a direct sovereign funding warning?
It all comes down to the carry trade. These vulnerable Rung 1 and Rung 3 emerging markets rely on a constant flow of global liquidity to roll over their debts, including those hidden FX swaps we talked about earlier.
Right, because investors borrow money cheaply in stable currencies and dump it into higher-yielding emerging market debt.
Exactly. And that trade works beautifully when volatility is low. But a high VIX with a flat curve, that signals persistent fear. It completely destroys the risk-adjusted returns of the carry trade.
So when that volatility curve flattens, the math just breaks down. The carry-funded flows are the very first things to reverse. The capital just flees back to safe havens.
Precisely. And when that global liquidity dries up, these fragile countries are doubly exposed. I mean, they're already hemorrhaging cash to absorb the fertilizer shock, and suddenly they're hit by the massive withdrawal of the global cash they rely on to keep their shadow ledgers funded.
The counterparties disappear.
Yeah. The off-balance sheet borrowing only works if there's someone willing to roll the debt over. When volatility spikes, those players leave the table.
Wow. It's just a perfect silent storm. So to synthesize the journey we've been on today, we started with the market staring at a car crash in Iran, pricing it as a standard crude oil disruption.
But we know a molecular shift has occurred.
Right. It's a natural gas and fertilizer shock that directly attacks the gas-to-grain transmission chain. And because governments can't let their populations starve, they are secretly blowing up their budgets to absorb those staggering costs.
Using FX swaps, encumbered assets, undisclosed derivatives.
Pawning their future revenues just to survive the planting season. And we tracked how that vulnerability is distributed, from Pakistan's fiscal illusions to Morocco's margin collapse.
And ultimately, how the boom in Latin America is completely masking this impending crisis from average investors.
The index funds are lying to us. So the ultimate takeaway here isn't just about predicting the next shock. True insight, the most durable advantage in understanding global events, comes from knowing exactly whose balance sheet was already too fragile to handle the shock that just arrived.
Exactly. The Iran conflict didn't create the vulnerability. It just activated the structural weaknesses that were already there. Understanding that lets you see the real risk before the broader market catches on.
Well said. Thank you for joining us on this deep dive. And we want to leave you with one final thing to chew on, something that extends beyond the bond spreads and the volatility curves.
Yeah, the human element.
Right. We know governments are using all this off-balance sheet financial engineering to hide the massive cost of keeping food affordable. They are quietly racking up immense shadow debt just to secure their citizens' daily bread. But what happens when the citizens of these vulnerable countries inevitably discover the true scale of the debt being taken out in their name?
When the counterparties pull back and the derivatives bill comes due.
Exactly. Will the eventual breaking point just be a standard economic default that the IMF can neatly restructure in some boardroom? Or will it trigger a catastrophic political earthquake that the financial markets are entirely unequipped to measure? The market is still staring at the car crash on the left side of the street, completely ignoring the sinkhole. Keep your eyes open.